Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
The next question is from a listener. Hello, afternoon. Love the podcast. Although I'm not ready, I am interested in how to go about setting up financial investments for kids. One day as a parent, I'd like to dollar cost average into exchange traded funds for my eventual children. So someone's planning a long way ahead. Wonder what way is best. So I think the first thing I'd start with is what are your goals and why are you investing for the kids? Because some people want to put money aside for school fees. Maybe if you're putting money for school fees or private school fees, that's going to look very different than I want to put money aside to give them a house deposit when they're 30 years old. A completely different time frame, different amounts of money. You might have longer term. I mean, some people even want to put money aside so they can give their kids a present when they're 50 years old or something like that. So I guess it's starting with what do you want to use the money for these future kids? Maybe the money might even be so you've got, you can take a year off when your kids are born. So that's a different time frame again. And maybe you'd want to focus on just building up a year's emergency fund or something like that, but a kid fund.
Yeah, totally. I was going to say, the reason that you're asking these things is because when you, not only is it time frame, there are some financial advisors will be able to help you with this. There are some actual products, we call them products in finance, that might actually suit different things like education over, say, a house deposit. So those are different things for you to consider too, as well as, we've got investment properties for negative gearing, trusts and all that sort of stuff. That's a really good way to start. Well, what else would you look at?
Yeah, absolutely. So once you sort of figure out, maybe you want to save for two different things. Maybe you want to save for when a year's living expenses for when they're born, and then you want to save for school fees once they're 13 or something like that. So have a look at, once you've worked out the different sort of scenarios, have a look at some different compounding scenarios. So look at the Money Smart Compound Interest Calculator. That's one of our favorite tools over here.
Yes, totally.
And see just spend half an hour plugging in numbers and see what kind of money you might need to put aside if you say want $10,000 for when your kid's born, and you think that's maybe 5 years away, how much do you want to put aside each month into a special account? And that's something good. Otherwise, if you wanted to give them a house deposit when they're 25, then you've got a lot longer to save, invest and put money aside for. So yeah, have a play around with that calculator and see if it's something that you can do.
Absolutely. I think it's the best calculator. We tried to create one ourselves. It's good, but it's not as good as the Money Smart one, I've got to be honest. So hopefully we can get a developer on board and revamp those. But what's really important about this, and I think the question that's always so ambiguous for a lot of people is tax. So if I'm investing for my children, how do I structure it so that tax isn't an issue? So a few years ago, it was possible, when I say a few years ago, quite a few years ago now, it was possible that when you had, say, a business or something like that, you could actually split incomes with kids. And so they would pay, tax up to the tax-free threshold, and then they would only start paying tax after that amount. And that income splitting is something that changed the rules in a lot of ways, because it meant that people could no longer just simply give money to their kids in their kids' bank account as a way to get money to themselves without paying tax. So the really important one here, and there's an article on this on the Market Index website, which we'll put in the show notes, so Market Index, and it's buying shares for kids. And it's a really good one. And basically it comes down to speaking with your accountant and knowing whose name those shares are held in. Because there's a few different methods here. And this is where it gets confusing. It's like a rat race for people. My financial advisor can give me advice on insurance bonds, but my tax accountant can only give me advice on tax and putting my tax file number in certain places. But he won't tell me if it can go in a share brokerage account? Like, this is where it gets so messy for people. But I'd go and check out that market index article, because it can actually come down to where you put your tax file number or whose name are the shares held in. Because it might be a taxable event when you sell shares, or you might be able to you might even on their 18th birthday want to give them the shares or want to give them the ETFs. You really shouldn't have to, in my opinion, you shouldn't have to pay tax if you put that money aside for your kids and you pay income tax as you go. But that's the reality is, if you don't do it right, you might end up paying tax based on the investments, even if they just transfer to your children's name. Yeah. So Vanguard also has a really good resources on this too.
And I think sometimes people can overcomplicate it because they really want to put the shares or the money in their kid's individual name. And sometimes it can be simpler just to put it in a separate account in your own name and just, record it in a spreadsheet as a separate line item or something like that. Just sort of like name it virtually, not have it legally recorded, because it can get really complicated, and not every company is willing to set up accounts with parent as trustee for minor and things like that. So definitely have a look. Don't try and overcomplicate it, because it could get you into a messy tax scenario. But I guess your different options, I think we've discussed in the past, but there's like insurance/education bonds that you can get. There's a couple of companies that do that, but I think we looked in the past, the fees are quite high. Yeah,
you've got to be really careful. Really careful. Rules. Yeah, there's a lot of rules. And typically, just as a general overview of insurance or education bonds, you're going to pay higher fees. It's typically for like people that have a higher income, but also the maximum benefits from insurance bonds from a tax perspective, my understanding is it's after 10 years. So you've got to hold them for quite a long time before, things actually start to fall your way. And that can mean, the rules might change between now and then. We've seen super rules change how many times in the last 2 years. So you've got to read the PDS, you've got to understand the risks, and that's where a financial advisor is really important before getting involved with those.
And then your other options are maybe buying individual shares directly, buying ETFs directly, or using a robo-advisor, or even just putting the money aside in a bank account. If you're thinking you might want it to take paternity leave for a longer period than maybe your workplace will cover, maybe and you think that's going to happen the next few years, maybe just put that money aside in a bank account so there's sort of a no risk on the line.
Yeah, another option kind of in between those two, between cash and between investing, Kate, would be to have an offset account. So, that
if you've got a property,
it doesn't actually earn you interest, but it actually saves you on your mortgage. So you're paying less in your mortgage, but if you worked out in after-tax dollars, so if you adjusted for tax, chances are the return on putting it in your offset account is theoretically, I'm using air quotes for those people that are not watching the video, theoretically it's better. So that's something to consider too. But you know what? I'm going to give you a real life example. I have a younger sister. I'm about, crunches numbers in his head, 19 years older than her. So she's quite a bit younger than me. And I initially had a program set up where I had a Vanguard ETF, and I had it in my own name. And I just wanted to just dollar cost average every birthday. I think it was $500 because that's the minimum for an ETF, right? Every birthday of hers, it was $500. And I chose an ETF that was really high risk because I didn't want to give it to her till her 21st. So that's like 20 years. So I could afford to take the risk. And the other thing I wanted to do was find an ETF that didn't actively trade shares. So it was just like a really boring vanilla shares ETF, because that results in lower turnover inside the portfolio. Something we haven't talked about before, but what it means is lower taxes. So that's what I went with. But that's just there's no rhyme or reason to that. That's just kind of, I guess, from my personal preference.
Yeah. And I guess the last thing with this is if you can automate this, especially if you're going to be investing over a 20 or 30 year time frame and you're putting away $50, $100 a month, if you can automate either like a direct debit into a certain bank account or some way there's a few platforms now where you can actually automate the purchase of shares and ETFs. So have a look at that. It makes it a lot easier if you're doing something over a long time. I mean, I've had one automated investment set up for the last 2.5 years now, and it's just sort of slowly happened in the background, and I check in with it maybe twice a year. when sort of end of year and tax time, and it just sort of has been slowly building away for a few years, and that makes it so much easier.
Yeah, we were saying the other day for listeners, we were saying the other day on Slack that we all really want to hear Kate's investing strategy, even though we know you're not the expert and whatever you call yourself. Like it's, I think just the way you automate your finances is really cool. So we'll cover that in a future episode.